Dear all, welcome to this webinar on the key takeaways of PwC's Global Family Office and Deals Survey for 2024. My name is Karina Heilesen Jensen, and today I'm welcoming you in my capacity as the EMEA and PwC Denmark's Family Business and Family Office leader. To take us through the key takeaways of the study, we have invited Johannes Rettig here next to me, our EMEA Family Office and Deals leader, who is actually also responsible for conducting the survey. During the next 20 to 25 minutes, Johannes will tell us more about how family offices and not least family capital play an increasingly important role in the investment landscape. He will tell us about how deal volumes have developed, the number of investments exits done in 2024 compared to previous years, and not least which assets you as family offices prefer when you do your investments. To some of us, 2024 has been a little bit a slow year, and we could have wished for more activity. But putting on the positive goggles, looking into the study, there might be a glimpse of hope, of light out there at the end of the tunnel. But I'll let you tell us more about that, Johannes. The word is yours.
Thanks very much, Karina, and thanks very much for the invitation. Yeah, good morning. And I'm Johannes Rettig. I'm a director within the family business team, and I'm supporting as a EMEA Family Office and Deals leader our practice worldwide and especially in Europe with regard to family office, their investment strategies and deals. In response to requests from our colleagues from PwC Deals, we've been developing further insights, deeper insights into into family offices, their deal flow and transactions. So what we are focusing on are today 5 asset classes that we are exploring in our study. And it is startups, investments in startups, M&A, private equity, funds, and real estate. What you will learn is that family offices are important players in the global investment markets. And within this global landscape, we see unique characteristics, especially for family offices in Denmark, their deal flow and their transactions, so especially the capital allocation. So before now I guide you through our key findings, let me first explain what we understand when we are talking about a family office. Yeah, first, the view that they are all the same is completely misguided. Historically, academics have grouped family offices into 4 categories: single family offices, multifamily, embedded, and virtual family offices. However, over time, real-world practice has seen several other flavors of family office emerge, each with its own distinct approach, structure, and strategy. These include principal or family investment offices, principal or family investment funds, family investment holdings, and family business venture arms. In each case, the defining characteristic is that family wealth, or as we term it at PwC, family capital, is the ultimate source of the financial resources being invested. That's why, for the purposes of this analysis, we include all of these types of entity in our definition of family offices. Another common misconception about family office is that most of them are created through a cash event, such as a company sale. In fact, this applies to only 20% of family offices. For the other 80%, the original family business is still active as a source of wealth. In terms of ownership, the vast majority, around 3/4, of family office owners have an entrepreneurial background in their own right, and just 5% are owned by heirs. There's also a growing proportion of family offices owned by tech titans or hedge fund managers, the so-called Wall Street billionaires. This background or heritage can influence where and how they invest, Finally, looking across the universe of family offices that we've analyzed globally, about 75% have been established since 1990 and around half since 2006. So they are mostly quite young entities. Before I go into the details, into the deals these family offices do, let's look at where they're based and how big they are. We've been researching family offices for well over a decade now. During that time, we've built up a database of more than 11,000 family offices worldwide to fuel and inform our analysis. Where are those family offices located? As you can see, the bulk are in North and Latin America, followed by Europe and Asia Pacific. Then we have smaller concentrations in the Middle East and Africa. As you can see, the figure for Europe includes a thriving community of more than 120 family offices based in Denmark, with median assets under management of $750 million. The comprehensive global database containing this information is a truly unique resource that is PwC's proprietary intellectual property, and it enables us to provide similarly detailed data on virtually any country worldwide. It also allows us to generate some valuable insights at a regional and global level, like the fact that 30% of family offices worldwide manage assets of at least $1 billion, and that the Middle East ranks ahead of Africa and Asia Pacific in terms of average assets under management, but behind the Americas and Europe. I now take you through the main findings from our latest global family office deal study. However, I do urge you to take the time, read the report in full, since it provides the most accurate and detailed picture available anywhere of how family wealth is being invested across the world. Here you can see the number and aggregate value of investments by family offices globally in each year over the past decade. What shines through is that both the volume and value of family office investments reached a peak in 2021 before suffering sharp declines over the following 2 years. However, our latest research reveals growing indications that this downward trend is leveling off, with signs of a recovery emerging, particularly in deal value, which saw a modest rebound in 2024, despite a further fall in deal volume. Turning to global exits by family offices, we find that deal volume is holding relatively steady and that overall deal value has picked up again. Both the volume and value of exits reached a peak in 2021 before falling back, but it's now apparent that stability has returned. In these charts, we track the balance of investments and exits by family offices over the past decade in terms of both deal volume and aggregate deal value. The data shows that the balance of investments and exits by deal volume fell by more than half between 2021 and the end of 2024. Meanwhile, family offices spending on investments was consistently higher than the income they realized from exits. While the overall value of exits fell between 2021 to 2023, the year 2024 saw this value rebound by more than 1/4, again reflecting the renewed stability. In terms of the asset classes where they focus their investments, there's been a clear trend across the past decade for family office to shift away from real estate and funds and towards direct investments, including startups, M&A, and private equity. As recently as 2015, real estate and funds accounted for more than half of family offices' deal flow. In 2024, direct investments in companies accounted for more than 2/3 of their deals. It's also interesting to note that the volume of family offices' investments in funds has declined significantly over the past 4 years, while their private equity investments have been rising. Looking across the 5 key asset classes for family offices, namely startups, private equity, real estate, funds, and mergers and acquisitions or direct investments, our data underlines the major contribution that family offices now make to the global investment landscape. Most strikingly, in 2024, they were the source of 40% of the total capital raised by startups. They also provided a significant slice of the capital invested in the other 4 asset classes. We've looked at the asset classes in which family offices are investing, but how big are the checks they are writing for each investment? As we can see over the past decade, they've consistently favored small deals worth below $25 million. This preference has continued in 2024, though they are also showing a growing desire to get involved in medium-sized and large deals. During the year, 64% of family office investments were in small deals, down from 71% in 2023. Meanwhile, medium-sized and large deals combined recorded a corresponding increase, rising 6 percentage points year on year. As well as looking at deal volume, value, asset class, and size, our analysis also tracks the proportion of club deals, where family offices co-invest and share risk jointly with other investors, as opposed to sole deals where they invest alone. As this chart shows, family office general preference for smaller deals is accompanied by a liking for club deals as a way to reduce and share risk. For several years, starting from 2016, the share of club deals in family office deal flow rose steadily, reaching a peak of 72% in 2022. But the rising trend has reversed slightly in the past 2 years, with the proportion of club deals slipping to 66% in 2024. An analysis of family office investments by region of the world shows that the Americas, and particularly the United States, was a deal destination of choice in 2024, having leapfrogged Europe to take first place. This rebound by the US marks a major trend shift. Between 2015 and 2023, family office investments in the US were generally declining, falling by 22 percentage points. By contrast, family offices' investments into Europe rose by 20 percentage points over the same period to a peak of 53% in 2023. But 2024 saw a significant turnaround, with renewed interest in the US pushing its share of deals up by 10 percentage points and Europe falling sharply. Asia Pacific also recorded an increased share of deals. So that's my whistle-stop tour of the headline findings from our latest family office deal survey. Now I'll move on to our series of drill downs into the data, looking first at the family office and impact investments. Let's begin by defining what we mean by impact investments. As you can see, the global impact investing network characterizes them as investments made with the intention to generate positive, measurable, social and environmental impact alongside financial return. They can be made across a range of asset classes, including the 4 where family offices are most active, and they provide capital to tackle challenges in key sectors for society, like sustainable agriculture, renewable energy, microfinance, healthcare, education, and affordable housing. Family offices have become increasingly significant impact investors in the past 10 years, steadily increasing their proportion of sustainable investments across all asset classes. A significant tipping point occurred in 2022, when for the first time, sustainable investments overtook traditional investments to account for more than half of family offices' deal volume. It's a position that they have held on to since then. But which sectors are family offices targeting with their sustainable investments? Here are the proportion of the impact investments across the 6 sectors I highlighted earlier: education, renewable energy, microfinance, sustainable agriculture, healthcare, and affordable housing. As the charts show, family offices' impact investments in 2024 were focused mainly on education and renewable energy by both volume and value. Interestingly, affordable housing represented only a very small proportion of their impact investments, perhaps reflecting the relatively low yields on offer in that sector recently. I now explore what our data tells us about a Danish family office investment strategy. First, Danish family offices haven't been immune to the recent global trends. Following a peak in 2021, they've recorded a significant decline in deal volume over the years since then, with the aggregate deal value also falling in 2023. However, while their deal volume slipped further in 2024, deal value doubled year on year, a very positive sign for the future. Turning to exits, looking back over the past 10 years, both deal volume and value for exits by Danish family office have been relatively volatile, often with quite sharp swings in either direction year on year. While exit volumes suffered a brief downward blip in 2023, they then leaped by more than 1/3 in 2024, with exit value jumping by an even more impressive by 156%. A comparison of investments and exits by Danish family offices over the decade shows that the net effect is that their investments exceed their exits in most years. Between 2022 and 2023, the balance in terms of deal volume between investments and exits rose by more than 50%, but then fell back again by 38% in 2024. Over the past decade, Danish family offices' spending on investments has surpassed their income from exits in 7 out of 10 years. Here we look at Danish family office contribution in 2024 to local market deal value in their 5 main asset classes. As the charts show, they've provided 10% of the capital raised by local startups, as well as accounting for 27% of total deal value in real estate, 13% in private equity, 3% in direct investments, and 1% in local funds. In common with family office elsewhere, Danish family office have transitioned over the past decade from real estate and funds towards direct investments in startups, M&A, and private equity. It's been a fairly volatile journey, characterized by sharp changes year on year. But the overall direction of travel is clear. In 2015, real estate and funds accounted for 56% of their deals. In 2024, 55% of their deals were direct investments in companies, including startups, M&A, and private equity. Within this total, 2024 saw a significant rebound in their investments in private equity and M&A. While family office globally shifted slightly towards mid-sized and larger deals in 2024, Danish family offices went the other way, moving their focus back towards deals below $25 million as mid-sized and larger transactions declined. In 2024, 2/3 of Danish family office investments were small deals, with a proportion of medium-sized and large deals, each declining by 15 percentage points from their levels in 2023. The 21% share of medium-sized deals during 2024 represents the lowest recorded in the decade. Throughout the decade, Danish family offices have exhibited a generally strong, albeit uneven, preference for investing via club deals. These have accounted for more than half of their deals every year. In 2024, the share of club deals was 61%, the same as in 2015. Club deals claimed their largest share of the decade in 2017 and their smallest in 2023. The past 2 years have seen sharp rises in outbound investment by Danish family office. In 2024, these accounted for more than half of their total investments for the first time. While family offices globally shifted their investment focus from Europe to the US in 2024, Danish family offices bucked this trend, strengthening their existing strong focus on Europe. An overwhelming 90% of their outbound deal volume during the year consisted of investments within Europe, up by 1 percentage point on 2023. The only year when Europe has accounted for less than 70% of their deals outside Denmark was 2022, when the Americas share spiked at 35%. Well, now briefly explore Danish family office involvement in impact investment. As we've already seen, the deal flow for family office globally now consists of more than 50% impact investments, but Danish family office are below that level. In fact, the 41% share of impact investments in the deal volume in 2024 is the same as it was in 2015. And while the proportion has reached 48% in 3 separate years, it has never got to 50%. Turning to sectors for impact investments by Danish family office in 2024, healthcare and education leads the way in terms of deal volume. However, healthcare is even more dominant on deal value, accounting for more than 80% of the capital investment, well ahead of renewable energy and education. So, taking a step back, what are the main learnings from this year's analysis? First, the key trends we've revealed. As we've seen, family office investments now appear to be stabilizing after a 2-year dip, and the expenditure on those investments has exceeded the value of exits over the past decade. However, the situation is different in Denmark, where the value of exits has exceeded investment expenditure in at least 3 of the past 10 years, indicating healthy returns. At the same time, family offices have become major players in various asset classes, notably startups globally and real estate in Denmark. And since 2015, they've been refocusing away from real estate and funds and towards direct investments, most recently private equity and M&A. For more trends to note, club deals continue to dominate family office deal flow, as do smaller deals. And while medium-sized and larger deals are on the rise globally, Danish family offices shifted the other way in 2024, back towards smaller deals. Another difference, the US is the top destination for family office investments globally, but Danish family offices focus strongly on other European countries when investing outside Denmark. And while most family office deals globally are now impact investments, the proportion for Danish family offices have never reached 50% and was just 41% in 2024. So that concludes my presentation. Thanks for listening, and I'll be delighted to answer any questions you may have. Thanks very much.
Thank you very much, Johannes, for taking us through the key takeaways of this year's Family Office and Deals survey. It's been interesting hearing about the trends globally, but not least in Denmark. And we here at PwC Denmark are looking forward to following the investments that you outside behind the screens will be doing during 2025. We are excited to see whether you will still take an interest in the direct investments, especially the startup and the scale-up, or whether you will have a focus on other asset classes and categories. And of course, due to the latest announced changes to the Danish succession planning rules from a tax perspective, we are also interested in seeing whether you will increase your portfolio of real estate, thereby making your family business and the group of companies more adequate to a tax-efficient succession planning. Once again, thank you all for joining. We hope that you felt the time was well spent, and we look forward to welcoming you at other events within family business and family office. Thank you. Have a nice day.
Thank you.